my basic message is if the U.S. economy is creating 200,000 jobs a month, month after month, we're not at maximum employment. And so that's the continued surprise, and that's been leading me to take my policy position.
So is it that we all bought into the baby boomer, that's why the people that are out of the workforce, everyone uses that and says that it's not that they're, that's what was it was at a 40-year low or something, what,
right,
60%?
Just the aging workforce. But
that was the excuse, but there were a lot of 25 to 54-year-old people that were in there that you can't write off as baby boomers that weren't working, that weren't being counted. Is that where we got the 200,000 every month?
That's part of it. But basically, the 3.7%, that's the headline unemployment rate, that's usually been a pretty good proxy for slack in the labor market. But the Great Recession was so devastating, it just pushed a lot of people out of the job market, and they are only slowly come back in. And so we don't know. If wage growth actually picks up, we don't know how many more are going to come back in, how many more retirees will say, you know what, I'm going to work for a few more years. We just don't know. So my view is, until we see wage growth really pick up, until we see inflation pick up or inflation expectations pick up, let's let the job market continue to
That's such an appealing thing to me now. I never was before. I figure, we got to get ready for the next time and build up some dry powder so we can cut rates and all that stuff. But if all you have is a strong economy, and for some reason there's not the fear or the prospect of higher inflation, I don't see why you just arbitrarily have to raise rates just to do it if you're not seeing any nascent inflation.
Exactly. So if wage growth were to pick up to levels that would imply high future inflation, or inflation picked up,
then
or inflation expectations, then absolutely.
So how many of the 7 increases would you not have done?
I think that we should be normalizing rates.
We don't know what normal is now. Jay Powell changes his mind on normal depending on the...
There's a lot of uncertainty around where the neutral rate is. I think we're close to neutral. Maybe not quite there yet, but close. That's what I said in my op-ed.
That's what he said. After he said we're far away from neutral.
There are huge ranges of uncertainty around these things. But that's why I look at the data, look at inflation expectations, look at wage growth, and look at job growth. All of that says there's still slack.
Hey, Neel, the problem with that theory, and the critics who have jumped on it have said, look, in the past, every time the Fed has gone to raise rates or has tried to stop inflation, they've waited too long. If you wait till you see the whites of inflation's eyes, it's too late in the game. The Fed misses it. What do you say back to those critics?
I say that
here's how we do it differently this time.
Inflation expectations are so anchored because of the political independence of the Fed, because the Fed has done a good job over the last 20 or 30 years. That, to me, is something that's enabling this economy to continue to strengthen, enabling the job market to continue to strengthen without inflation taking off. And so, let's let it continue.
It is historically what has caused us the most problems: being behind the curve on inflation, or
raising rates
strangling
too fast
off
and cutting the economic,
going too far in strangling the economy.
Well, I mean,
what's more likely? What are you worried about?
I'm more worried about that we raise rates prematurely when the job market still has slack and wage growth hasn't picked up yet.
And that's certainly been the historical precedent recently.
We know, I believe certainly that if the Fed were to raise rates dramatically, we could cause a recession. Nobody wants to do that.